Wall Street just made a huge mistake, and it starts with what they teach. Because one of the most misunderstood tools in finance is something called an option. A few days ago, I stumbled upon a great book in my bookcase, the exact same book that opened my way in this business. Options, Futures, and Other Derivatives by John C. Hull. Thanks for the input, man. You are a legend. So, today, I want you to understand what these options are and how to use them like an expert trader would. Now, I know, the word itself sounds intimidating, but let me put it in simple terms. Let's use Apple, the company everyone knows, as our playground today. Imagine Apple's stock is trading at, say, $150. There are two main types of options, calls and puts. Think of them as two sides of the same coin. These options control 100 shares, so everything we discuss next makes it multiplied by 100. A call is nothing more than a promise. That's it. A promise that, regardless of how much a stock will rise in value over a period of time, someone would still sell me the stock at the value that I buy the contract. So, I see that Apple stock is rising, and I want to be sure that I will buy it cheaper. I will buy a call at the strike price of 170 with an expiration date of about 3 weeks, because it usually is on every third Friday of every month. What's the reason for this? I hope that the stock over these 3 weeks will rise above this 170, and it will be 200, for example. In this situation, I will exercise this promise. The writer or the investor who is selling the call to me is required to sell even if the stock is 250. And later, I will sell these in the market, even though I didn't have the stocks at all in the first place. But the catch is that this promise, over 3 weeks, will cost me $20, let's say. If the stock doesn't go over 170, the $20 will be all that I will lose, because it doesn't make sense to exercise the call. And to break even at least, the stock must rise to 190. Sounds hard to understand at first, but I promise that will make sense over time. With repetition and practice, you will see the results when you're smarter than the other 90%. Now, if you know the basics, let's go deeper in this game. While I said that the promise will cost some premium, you must know that this premium might oscillate, up or down. Because if tomorrow my stock goes from 150 to 140, the promise will cost $18. If it goes to 130, it will cost $15, and so on. Complementary. If Apple goes from 150 to 170, the premium will be $28. This premium depends on two factors: on time, or the amount of time before the contract expires, which means 3 weeks later, and also on the volatility of the stock. If this volatility is high, the price of our promise will be higher. Or if the volatility tends to lower, the price of our promise also tends to be lower. But also, volatility can be high if the stock drastically rises or drastically plummets. Yes, complicated, but that's the main thing you want to know in this episode. This strategy, as you discovered, bets on the rise of the stock. And there is a strategy betting on the fall of the stock too. This is the put option. Put option is the opposite of the call option. It's a promise as well, but a promise that regardless of how much a stock will decrease in value over a period of time, I would still sell the stock at the value that I buy the contract. Here's the example. I think that Apple will go down for some reason. The stock is still at 150, but I buy a put at 140, and I pay $18 as a premium. Knowing how a call works, now you think that I will only make money under the break-even. Like if the stock goes under 122, right? Yes, it is right. But only if I wait until the expiration date, 3 weeks later. But if the stock already went to 138, the promise will cost more than $18. Why? Because it already went under 140, so evidently the volatility drastically rose, and the chances that the stock will go under 140 further rose as well. That's why the cost of our promise rises. In fact, think of putty options as insurance policies. Big investors often buy puts, not because they're certain Apple will crash, but because they want to protect themselves in case it does. Just like you buy car insurance, hoping you never have to use it. Investors buy puts, hoping the market keeps rising. If it doesn't, they've got protection. So now you understand the basics. Calls for upside, puts for downside. But let me show you how traders combine them, because this is where it gets interesting. One of the most common and easy tactics is called a spread. It can be a call spread or a put spread. It can work both ways, depending on the market trends. Both of these strategies are preferred instead of a naked option because they offered a limited profit, but offered instead a capped loss that we knew from the beginning. Imagine a call spread on our Apple stock that is 150. We buy a call at 160 and sell a call at 180. What do we want with this position? We want to profit from a moderate increase in the price of the Apple stock. We want to buy a call at a lower strike price and simultaneously sell a call at a higher strike price, but on the same expiration date. When the stock rises above 180, we exercise the option. We bought a call at 160, so we buy the stock at the expiration day much lower than the actual price. And we sell a call at 180, so we are forced to sell the stock at the expiration date at the exact price. And in this way, we are in profit with the exact difference between these numbers. Of course, when we buy, we pay the premium, and when we sell, we collect it. Making the difference will give the exact number. Now, let's imagine a put spread also on our Apple stock. We buy a put at 140 and sell a put at 120. What's our strategy here? We think that Apple will go through a moderate decrease in value. So we buy a put at a lower strike price than the present price of the stock, and at the same time, we sell a put at a lower price than where we buy, but on the same expiration date. When Apple goes below 120, we can exercise the option. We bought a put at 140, so we have the right to sell the stocks at the expiration date at that exact price. And we sell a put at 120, so we are forced to buy it at the expiration date at that price. In this way, our profit is capped and is the difference between these two, minus what we paid on the option.
Of this medium, we shall hope to learn to use it
and this is how
not
both
to
spread
abuse it.
options work. Options give you something rare in finance. Control. Control over how much you risk, how much you can gain, and how you respond to uncertainty. Stocks alone don't give you that. If you buy Apple shares at 150 and it falls to 130, you've lost $20 per share. And that's it. But with options, you can design a position where your maximum loss is known from day one. You can sleep at night knowing you won't wake up to a margin call. That's the beauty. When I was young, nobody told me how to think like this. But that's why I'm here now, to tell you that the real power comes from education. To trade without the proper education, it would be like gambling. And I don't teach gambling here. But let's say you have the money and you want to try. My advice here is simple. Only buy options with a long-term strategy. Choose an expiration date, like 3 months from now, for example, because if your position is not in the money, you can save it by rolling the option or closing that position, which means that you must execute an opposite transaction to the one that opened the position. If you have a long position, you bought the stock, you sell your shares. And if you have a short position, you sold borrowed shares, you buy those same shares back to close it. That's why I teach everyone to close their position on 50% profit. This is another reason as well, but more on this in a future episode. We'll go deeper into strategies, like how to generate income from selling covered calls, or how to use straddles and strangles to trade volatility itself. But for now, I only want to tell you that all operations in trading involve risks. Huge risks. So if you are not properly sure of your abilities, please do not try to enter this market. If you reached this far in the video, I want to thank you for being with us and supporting our work. Until the next time we meet, be safe, keep your family close, and join us for more educational videos.